Time for our headline of the day, ripped from the Wall Street Journal. House appraisals under fire. Homeowners saying computerized models used by some companies are spitting out lowball valuations and preventing them from refinancing or borrowing against their homes. So the computers are being mean.
Maybe so, but some are even suing banks that have cut off their home equity lines of credit based on some of those appraisals. Ken Brown is money and investing editor at the Wall Street Journal, and Shari Olefson is partner and real estate attorney at Fowler White Boggs and author of Foreclosure Nation, Mortgaging the American Dream. Welcome to both of you. Ken, it's great to see you again, old friend.
Yes, good to see you.
I'll start with you. There are two different ways in general to do an appraisal. One is the computer model that is frequently used because it's less expensive, and the other is paying up for the personal appraisal where the guy comes out and looks. The key issue, as I understand it, is more with the computer model. Is that correct?
Right. So the context is everyone knows that the human appraisals were too high during the bubble, and that led to bad loans and overpaying on houses. So what's happened now is people are using more of these computerized models, and they use them more for refinancings and mortgage modifications, things like that. And it is a computer, and it's a model, and it looks at previous sales. It looks at the size of the house. Basic factors you can plug into a computer model and spits out a price. The problem is people who obviously want a higher price are complaining that it's spitting out the prices that are too low.
Yeah, Shari, the other issue is that a lot of times there aren't a lot of sales for the computer to take into account, and therefore perhaps the comps aren't necessarily accurate. What do you agree with that? And what is the solution, do you think?
Yeah, well, there's no question, Sue. Anytime we're using models or computerized system, we're going to have somewhat of a mixed bag, and there is an issue with the data in. On top of that, the pendulum has certainly swung in the other direction in terms of tighter credit. I mean, this is exactly what we're talking about when we say that credit will get tighter and more costly for borrowers as we move forward. But whether or not that rises to the level of legal maldoing, which is what these lawsuits allege, is a whole different story. I mean, these lawsuits are alleging fraud on the part of the lenders, saying that they're intentionally using inaccurate or outdated data, unjust enrichment, breach of contract, those types of allegations, which I seriously doubt actually exist. And then, of course, allegations that the lenders are violating the Truth in Lending Act, which lays out how and when a lender can reduce the amount available under a line of credit, which is the main source for these lawsuits. You know, a lot of borrowers were caught by surprise when the lenders all of a sudden cut off or reduced the amount available on their lines of credit. And as we pointed out, the irony is 2 or 3 years ago, the same lawyers were suing the same banks for overinflating the appraisal values.
Well, it seems that both models tend to be flawed, right? I mean, you know, the computers, if they overemphasize the comps or the foreclosure side of it, how difficult is it to try to get fair value and understanding what fair value is for a home in a particular community?
Well, right, and that's the crux of the problem here. I mean, after all this time, people buying and selling houses forever, no one's figured out how to really value a house properly that you know can be used for a loan. I mean, it is amazing that we're having this controversy here. I mean, the human appraisal system has improved and there are no rules in place. The computer system, you know...
But, you know, it's been going on for a while. I mean, we did a community bank summit a year ago here on Power Lunch, and one of the big issues that we heard from the real estate industry was they could sell houses. They had a buyer and a seller. They agreed on a price, but the appraisal didn't even come close. So is it simply coming to a head now? Or, Shari, you want to take that?
Yeah, sure. Part of the problem here is that there really is a lack of uniform standard in the industry. I mean, it's really up to the banks what type of model they want to use and what type of standards they want to apply. And eventually, that's what will probably come out of these lawsuits, Sue, is some uniform standards in terms of the type of data, because we all know garbage in, garbage out. But in terms of how these computer models are assembled, what type of notice is given to the homeowners, because, of course, the last thing we want, I mean, that can be life-changing if you're caught by surprise and you're using your line of credit as a lifeline, what type of appeal process might be in place, and certainly some transparency in terms of how the lenders are appraising the properties. And
you know, obviously, but it seems that it's hard to standardize anything in this. I think that's what we're learning. But Ken, just finally, real quickly, how big a drag can this possibly be as we try to clear this out in 2011 in terms of inventory and stuff?
Well, in terms of house sales, these computerized for appraisals really only really only used for small homes for $250,000 or less. So it's not a sales thing. It's more of a refinancing thing. It's a modification thing. It's clearly a drag. It's, something that they need to work through.
All right. Thank you both very much. Appreciate it. Good to see you again, Ken.
Thank you.
Yeah, Happy New Year, guys. Coming up next,